Welcome back to the channel, everyone. Jay's here, and in today's episode I want to talk about Amazon recently saying they're going to get into the wireless market, potentially offering Prime members a super discounted rate on mobile services. Well, I'm a shareholder in one of my dividend accounts of Verizon, and I recently just bought some at&t stock because I think the news that broke shot these stock down even more than they've been over the last year. Both at&t and Verizon are down significantly over the past 1 to 2 years. And I think there's a great opportunity for dividend appreciation as well as stock price appreciation over time. So, okay, we always check out these articles in Verizon, and then I'm like, oh, I want to see more about this article, and then you click on continue reading, and Barron sends you to a paywall. So I like to use Forbes. They give you great little articles with great little headlines, and it goes to show you guys like what information you actually need. And like when you make any decision on a stock, you want to kind of figure out the bear case as well as the bull case. And we're going to check out this article here. Amazon could disrupt major mobile carriers and offer Prime members cheap or free wireless. Okay, there's a lot of bargain basement wireless things coming out lately. There's like Cricket, which my mom has, which is okay service. But if you want to do FaceTime and stuff like that, her FaceTime is not great being an iPhone user. And then there's like Mint Mobile, Ryan Reynolds, his little wireless thing. It's like $15 a month. I don't know anyone who has that, so I'm not sure how that works. But if we look at these, here comes some of the key facts. Amazon has reportedly been in talks with at&t, T-Mobile, Verizon, and Dish to negotiate low wholesale prices. So they'd be kind of like a middleman, and plans as low as $10 a month, which is absolutely amazing if the service is good. I don't know if that will include like internet and like FaceTime capabilities, but for $10 a month, a lot of consumers could definitely benefit from that. But every time Amazon gets into a new field, whether it's healthcare, then like Walgreens shot down and CVS shot down. And then when they got into Whole Foods, some of the, Kroger and Sprouts, their stocks went down. And, is Amazon in a potential, stretching themselves too thin? They're in so many businesses now. There's no way they can give you the service that someone like Verizon, T-Mobile, or at&t can, especially when they have so many other different business segments. But if you look on Friday, T-Mobile and at&t were down like 5 and 7% pre-market, which is significant considering these guys trade in a range, maybe 1.5% in a day. They're not huge movers, but these stocks are starting to get really interesting. So I'm going to bring up some of their charts. Look at Verizon Communications. They're currently given a 7.5% dividend, trading at a PE ratio of 6. I mean, Verizon's never going to trade at like a 20 PE because their growth is just not there if you look at their EPS. But at 7.5%, I mean, it's hard to argue like a better risk reward. Like, look, in the past year, they're down 13%. In the past year, we're down 31% on one of the biggest mobile communication companies in the world. It seems pretty attractive to me. So let's do a little more investigating on Verizon. So when you click on Yahoo, what I like to see is I like to see what's going on EPS wise. So the last Q1 2023, they did $1.20 in EPS. So I like to extrapolate that over a year. So since it's a quarter, you times that by 4. So you take that $1.20 and it becomes $4.80. So in a year, they're giving out $2.61. So that dividend is still well covered, and it gives them the ability to reinvest in the company. So at $4.80 that they're giving out, and that they're accumulating in EPS, they are giving out $2.61. So it still gives them around $2 in EPS to work with to reinvest in the company, expand the company. So I really like that. And I really like to go to historical data. Check this out. And then we're going to go to time period, right? I like to do, at least 5 years, and we'll see what comes up. And then we're going to go to this click on dividends only. And then frequency, we're going to go to monthly so we can see how they pay out each quarter. And then we hit apply. And if we look out, it goes back to 2018, and look, they've consistently increased that dividend almost every single year. And that's what you want to see as a dividend player. So if we get in at a really good valuation, so say we buy, Verizon at $34.58, and we're getting a 7.5% dividend. As the stock goes up and as they increase the dividend, our dividend percentage is going to be based on where we bought the shares at. So say at some point Verizon increases to, over the next 2 to 5 years, say it goes to like 0.85. Let's be a little more conservative. Let's do 0.8, say over the next 5 years. And then we're going to divide that, and we're going to times that by 4, because that gives you $3.20 per year that you're getting in dividends for every one share of Verizon you have. So we're going to divide that by the current share price of $34.58, and that's going to come to a 9% dividend. So say in the next 5 years it gets to 80 cents per quarter. You extrapolate that over a year, you get $3.20, and our percentage of dividends is based on where we bought the share. So we'll be getting almost a 9% dividend, which is pretty awesome to me. So I just bought AT&T stock. So I like Verizon a little bit more. I think the risk to reward on Verizon is more because Verizon was trading in the $50 and $60 range at one point. It's currently trading in the 30s. So AT&T just spun off their Warner Brothers segment of their business to Discovery. So they've been beat up. The last 5-year chart is ugly, but they're paying a 7.3% dividend. So over the last year, they're down, even in the past year, down 27%. So we're getting them, if you look at the 5-year chart, we're getting them at a significant discount. They're trading even lower than they were in 2020, but we got to remember that this share price is reflective of that Warner Brothers business that they did terrible things with. It's pretty much, I'm glad that they spun that off because they weren't able to capitalize on that segment of their business. So at $15.21, we're currently getting a 7% dividend, and we're going to do the same thing for AT&T. So we're going to, remember guys, we're going to go to time period first. We're going to click 5 years, and we're going to go to dividend only, and then we're going to go to monthly and then hit apply. So here is when they spun off the business recently. So they were given around 50 cents per share. So this is the new norm for them. So we're going to have to keep an eye on this historical data, and if they can keep the dividend around this range and maybe increase it over time, we'll also be able to get some share appreciation as well as dividend percentage appreciation. But I just bought some more AT&T. I bought some more Verizon. I like Verizon a little bit better. I think their business model is better. So if you guys are looking for some 2 really good dividends to add to a dividend portfolio or help balance out a growth portfolio, I love Verizon. And a close second place is AT&T because they're trading at such a depreciated valuation. I think it's going to give value to shareholders over time. Thank you guys so much for tuning in, and we'll catch you guys on the next video.